Good morning, and welcome to your daily news briefing. It's Thursday, June 19th, 2026, and yes, for those keeping track, that means it's Juneteenth, so take a moment to mark that. We've got a genuinely packed show today, from a stunning shift at the Federal Reserve to Jake Paul raising a 9-figure investment fund, which, yes, is a real sentence I just said, and a developing story about the Trump administration's pressure campaign on one of the country's most prominent AI companies. Let's get into it. We're going to start where the markets are starting, with the Federal Reserve, because what happened yesterday at Kevin Warsh's first meeting as Fed chairman is genuinely one of the more surprising turns in recent economic history, and it's worth slowing down to understand why. Here's the background. Kevin Warsh was handpicked by President Trump to lead the Federal Reserve. Trump, for essentially his entire second term, has been pushing loudly and publicly for the Fed to cut interest rates. He has bullied the central bank, he has cajoled it, he has complained about it. The assumption among many Wall Street observers was that a Trump pick would be inclined to accommodate that pressure. So imagine the surprise when Warsh, at his very first meeting, presided over a session where the Fed not only held rates steady for the fourth straight meeting, but signaled that the next move might actually be a rate increase. Let that sink in. Rate increases, not cuts. Here's what the new projections show. According to the latest so-called dot plot, that's the chart where Fed officials indicate where they think rates are headed. Roughly half of all policymakers now forecast one or more quarter-point interest rate increases by the end of this year. 3 officials penciled in 1 increase. 5 think the Fed will need to raise rates by a full half percentage point. And 1 official went even further, penciling in 3 quarter-point increases. Only 1 single official still thought a cut was coming this year. Futures traders this morning are pricing in at least 1 increase, possibly as early as October. Now, what is driving all of this? The answer is inflation, and specifically, the war with Iran. The Consumer Price Index rose 4.2% in May compared to a year earlier. That is a sharp jump from where we were before the conflict started in February, when annual inflation was running at 2.4%. It's the fastest pace of price increases since April 2023. And the engine behind it is energy. Energy prices were up 23.5% from a year ago. A gallon of gasoline now costs $4.15 on average, up more than $1 from this time last year. Think about what that means for ordinary Americans. Those price increases at the gas pump are wiping out the wage gains workers have gotten over the past year. When you adjust hourly earnings for inflation, real wages have actually fallen 0.7% over the past year. And they are exactly where they were when President Trump returned to office. Tax refunds from spring have been spent. Reductions to federal food assistance programs are now cutting into grocery budgets for millions of Americans. Stephen Brown, the chief North America economist at Capital Economics, put it plainly, it's quite a negative situation. Low-income consumers don't have a lot of room to maneuver at this point. You're seeing this in retail earnings. Dollar General told investors that its customers are pulling back on food purchases and looking to shop closer to home because gas prices are so high. Even consumers making more than $100,000 a year are coming into Dollar General for cheaper essentials. That tells you something about the breadth of this squeeze. Now, there is some reassuring news buried in these numbers for the Fed, and it matters a lot. The core inflation rate, which strips out the volatile food and energy categories and is considered the better measure of underlying price pressures, came in at 2.9% year-over-year, and only 0.2% for the month of May. That's actually slower than April. And prices for durable goods, like household furnishings and new vehicles, have been relatively tame, suggesting the tariffs Trump imposed last year have largely worked their way through the system. New cars are only 0.2% more expensive than a year ago. So what you have is a split picture, a headline inflation number that's screaming, driven almost entirely by energy, and a core inflation picture that's more manageable. That's what makes the Fed's job so difficult right now. And there's another dimension to this that Warsh has to navigate. The reliability of economic data itself has become politically charged. Trump this summer fired the head of the Bureau of Labor Statistics, the agency that produces the jobs report, after a jobs report showed unexpected weakness. He nominated a conservative economist with a history of distorting statistics to replace her. Economists across the spectrum criticized that decision. The good news, and economists do say this emphatically, is that the process of producing the monthly jobs report is so automated, so decentralized, and so tightly controlled that even a commissioner with ill intentions couldn't easily manipulate the numbers in the short run. The data is reported directly by companies through electronic systems with strict access controls, and the commissioner doesn't even see the final numbers until they're done. But the concern is longer term, that continued political attacks on the agency could erode its credibility and its talent. Back to Warsh and what his tenure might look like going forward. He has made clear that he wants to reform how the Fed operates. He called yesterday for regime change at the institution. He is skeptical of the practice of Fed officials openly sharing their economic views. Warsh has said he wants a quieter, more Greenspan-esque central bank. Jeffrey Roach, the chief economist at LPL Financial, wrote to investors after the press conference that we are going back to the days of Alan Greenspan when FOMC statements were deliberately minimalist. Warsh himself did not even submit his own projections to the dot plot, leaving it one entry short. He said he intentionally avoided giving any steer on where he thinks rates are headed. He wants the Fed to react to data, not pre-commit to a path. And he announced the creation of 5 task forces to look at how the Fed communicates, how it manages its massive balance sheet, currently sitting at $6.7 trillion, how it thinks about artificial intelligence's impact on productivity and jobs, and how it models inflation. One thing he was explicit about: bringing inflation back to the Fed's 2% target is job one. He called the current inflation trend a burden for the American people. Even Trump, who has spent so much energy pushing for lower rates, seemed to be slowly coming around to the reality of the situation. When reporters asked him about the prospect of higher rates, he said, "It could happen. It's hard to believe. It just keeps our country down. It's so unusual." Not exactly a ringing endorsement of higher rates, but notably, not the furious pushback you might have expected. Alright, so we've covered the federal. Let's shift to something happening on the global diplomatic stage, because while Warsh was making waves in Washington, the leaders of the world's wealthiest democracies were sitting down for a fish and cheese lunch in France. And at that table were some of the most powerful names in artificial intelligence. At the Group of 7 summit in Avion-les-Bains, Dario Amodei of Anthropic, Sam Altman of OpenAI, and Demis Hassabis of Google DeepMind joined world leaders for a working lunch on AI. And the message that tech executives were pushing was a specific and pointed one: don't let the United States crackdown on Anthropic's newest AI models cause democracies to splinter on AI policy. Aidan Gomez, the CEO of the Canadian AI company Cohere, who was at the lunch, said, "Everyone around the table agreed that the G7 needs to lead in deploying and regulating AI." Amodei urged G7 leaders to resist the temptation to splinter. Altman called for an international agreement on globally accepted standards for testing AI models, and emphasized that it was vital to avoid concentrating too much power with any one country. But the tensions were real. French President Emmanuel Macron was blunt about his concerns over American dominance in AI. He told reporters, "We won't buy any models made by these companies if overnight you can just flip the switch." Macron has been actively promoting Mistral, France's homegrown AI company, as a European counterweight to Silicon Valley giants. Mistral's CEO, Arthur Mensch, was at the lunch. Indian Prime Minister Narendra Modi also expressed concern about the Trump administration's moves against Anthropic. Now, what exactly is happening with Anthropic and the Trump administration? This is a story that has been rapidly evolving, and it goes beyond the G7 lunch. About a week ago, Anthropic executives received alarming news from the White House. They were told they had less than 90 minutes to take their newest AI models offline over national security concerns. Those models are called Fable 5 and Mythos 5. Inside the company, employee group chats immediately lit up. Workers were asking each other what was happening, what to tell clients, whether the company's plans to go public would be derailed. The backstory here is complicated. Anthropic had released Mythos, a powerful model, in April. The model was so capable at identifying security vulnerabilities in software that Anthropic itself called it a potential cybersecurity reckoning. Then this month, the company released a more restricted version called Fable 5, which it believed was safe for widespread use. Amazon, which has committed up to $33 billion in investment in Anthropic, ran some tests on Fable 5 and wrote a preliminary research paper pointing to a perceived security shortcoming. Using a specific approach, Amazon was able to get Fable 5 to disclose flaws in vulnerable software code. That paper made its way to the Trump administration, and officials called the results scary. But here's the critical context that cybersecurity experts immediately pushed back on: everything Fable 5 could do, OpenAI's latest model could also do. Amazon's paper didn't test other AI companies' models. And cybersecurity experts argue that the ability to identify code vulnerabilities is actually more useful for defense than for offense. Katie Moussouris, a prominent cybersecurity expert who reviewed Amazon's work at Anthropic's request, wrote that this wasn't a guardrail bypass at all. It was, in her words, the most valuable thing an AI model can do for defensive security. More than 150 cybersecurity experts signed an open letter calling on the Commerce Department and the National Cyber Director to lift the restrictions on Anthropic's models. Signatories included a former senior official at the National Security Agency and an AI expert at NVIDIA. Inside Anthropic, the mood has been described as a holding pattern verging on distress. Employees are confused, concerned, and asking hard questions in company chats. "Are we being bullied based on bad vibes?" one employee asked. Another, "At what point does this just feel like they don't want us to exist?" Dario Amodei has been meeting with Trump administration officials, but as of the G7 summit, there was no breakthrough. Trump himself said negotiations were going fine, but unnamed administration officials told reporters that the administration wants Anthropic to make its frontier models completely jailbreak-proof, something cybersecurity experts say is almost certainly technically impossible. There's also a talent dimension to this story. OpenAI executives have been telling the administration that building the best AI requires the best talent from around the world. That's a clear signal that immigration restrictions and geopolitical clampdowns create real competitive costs. One more consequential piece of this AI picture: the Trump administration is apparently split on how it wants to stake out a position in the AI industry itself. Treasury Secretary Scott Bessent has reportedly favored distributing equity stakes in major AI companies to so-called Trump accounts, essentially giving Americans a direct piece of the AI boom. Commerce Secretary Howard Lutnick prefers creating a sovereign wealth fund. Senator Bernie Sanders has drafted legislation for the sovereign fund approach. But many tech executives and Republicans have looked at both ideas with skepticism. Now let's talk about something that affects every American household more directly than any policy debate: what's happening to the cost of consumer electronics, and why Apple is warning that higher prices are coming. Tim Cook told the Wall Street Journal that price increases for Apple devices are now unavoidable. The culprit is memory and storage chips. Demand for these chips has been driven skyward by AI companies building out their data centers and computing infrastructure. Cook said the situation has become unsustainable. In related news, shares in Intel jumped in pre-market trading after Trump said the chipmaker would partner with Apple on US-made chips. And this brings us to a story that is both slightly surreal and deeply consequential: the AI boom's impact on everyday life, including something as mundane as your electricity bill and something as unexpected as whether you can sleep at night. The Times published a remarkable piece this week on what it's calling the cloud has sound. As tech giants rush to build the data centers that power AI, those facilities are sprouting up across America, and some of the people living near them are suffering. The problem is low-frequency noise. Data centers require massive industrial fans to cool the servers inside. They run around the clock. And the sound they produce includes infrasound, extremely low-frequency vibrations that fall below the threshold of human hearing, but that people can physically feel, as pressure in their body, like a bass drum shaking your chest at a concert, but unending. Residents in 3 cities filed lawsuits last month over data center noise. In Vineland, New Jersey. In Dowagiac, Michigan. In Lowell, Massachusetts. People are reporting chronic sleep deprivation, headaches, internal ear pressure, anxiety. One resident near Lowell described the noise as a helicopter that never moves and at times like a heavy-duty truck running constantly. There are currently more than 3,000 operational data centers in the United States, with another 1,500 in development. Nearly 40% of American homes are within 5 miles of at least one. An existing noise regulation was simply not designed for this. Local zoning ordinances were written to address block parties and barking dogs. The Reagan administration defunded the EPA's noise office in the early 1980s, and it has never been reconstituted. So there's essentially no federal enforcement authority. There is movement toward solutions, liquid cooling systems that reduce data center noise by more than 50%, but they're far more expensive to install, and the build-out is already underway with traditional infrastructure. Meanwhile, AI data centers are now consuming more than 4% of America's total electricity, a figure expected to rise to as much as 12% within 3 years. That's part of why electricity prices have risen nearly 6% from last year nationally. And it's showing up in airline tickets, which have risen 26.7% from a year ago, largely because of jet fuel costs. Alright, let's get to a story that's a bit more fun, while still being genuinely significant for what it signals about how American finance is changing. Jake Paul is raising a $100 million growth stage investment fund. Yes, that Jake Paul. Influencer, boxer, content creator, and now, apparently, serious venture capitalist. Paul co-founded Anti-Fund with the investor Jeffrey Wu back in 2021, starting as a small rolling fund on AngelList. The firm has now closed its first growth capital fund at exactly $100 million, bringing total assets under management to $180 million. Logan Paul, Jake's brother, is also a general partner. The investors in the fund include some serious institutional names: Aquarian Holdings, a $27 billion investment firm, Focus Point Private Capital Group, Daniel Michelow, a former partner at the legendary hedge fund D. Shaw, and Matt Holt, a founder of the private equity firm Thoreau Group and former executive at New Mountain Capital. And the portfolio is not a joke. Anti-Fund's investments include OpenAI, SpaceX before it went public, and the drone maker Anduril. The growth fund has invested in Saronic, which makes boat drones, Etched, which designs AI chips, and Erebor, a digital bank focused on startups. Paul told DealBook, and I'm quoting him directly, "Fame gets me in the right rooms at the right time, and my business knowledge allows me to strike the right deals and partnerships." He added that his goal is to be regarded as the best celeb investor of my generation. What's notable here is the broader trend Paul represents. For years, Wall Street firms would bring celebrities into their funds as a way of attracting wealthy clients, basically, stars as marketing. Now celebrities are building their own funds, using their platforms and personal relationships to gain access to deals that were previously restricted to institutional investors and insiders. Paul joins names like Andre Iguodala, who built a similar path from NBA star to venture capitalist. Patrick Mahomes, Aaron Rodgers, Steph Curry. Athletes are increasingly operating in investment circles in ways that were unheard of a decade ago. Paul's investment thesis, for what it's worth, focuses on what he calls the future: robotics in defense and manufacturing, semiconductors, power infrastructure, and specialized AI labs. He pointed to Cognition AI, which makes AI agent software, and Helion, a startup focused on nuclear fusion, as examples of where he sees opportunity. Let's run through some of the other headlines moving markets and conversations today. On the deal front, Goldman Sachs and Morgan Stanley are expected to lead the IPOs of both OpenAI and Anthropic, though notably, the banks will use different bankers for each deal, given the competitive nature of those clients. Thoma Bravo, the private equity firm, surrendered Medallia, a software company, to its lenders after potentially losing its entire $5 billion investment, one of the largest losses ever for a private equity deal. And Accenture agreed to buy a majority stake in Dragos, a cybersecurity provider, plus two other companies, for a combined $4.2 billion. In tech, Relaf Boda, the former leader of Sequoia Capital, is joining SpaceX's board, reuniting him with fellow PayPal alum Elon Musk. And OpenAI made a significant talent acquisition, poaching Noam Shazir from Google. If that name is unfamiliar, here's why it matters. Shazir is one of the co-authors of the research paper that is widely credited with kicking off the entire AI boom. Snap had a rough day. Shares fell sharply after the company announced its latest augmented reality glasses, priced at $2,195. That price point puts them in expensive territory, more comparable to Apple's Vision Pro, which, as you may recall, struggled with consumer adoption, than to sleeker, cheaper rival products from Meta. Snap has already laid off about 1,000 workers this year and drawn activist investors over its persistent lack of profits. And in a story that falls somewhere between heartwarming and absurd, Allbirds, the sustainable shoe company, has renamed itself Smartbird and hired a former Amazon executive as CEO to pivot toward artificial intelligence infrastructure. Its shares jumped 39% on the announcement. We'll close with a conversation the DealBook team had with Dan Leder, the CEO of Prologis, the giant logistics real estate company. Every week, DealBook asks business leaders how they're using AI in their operations. Leder described how Prologis is using AI to make faster, better real estate decisions. Questions like, how much can we raise rent in a specific building? What buildings in Chicago should we be focused on that we don't own? What buildings do we own that we should be selling? He also described a company-wide AI challenge, a Shark Tank-style competition where teams of 3 or 4 people built AI role companions to do or augment a job. The whole thing was scored by AI. His team, for the record, chose to build one for the CEO role. They did not win. The winning team had built something for a more specific role, which was executing a repeatable process. There's probably a lesson in there for all of us. And that's your briefing for Thursday, June 19th. A hawkish Federal Reserve, inflation at a 3-year high, AI companies at the center of a geopolitical standoff, and Jake Paul raising a 9-figure venture fund. DealBook will be off tomorrow for the Juneteenth holiday. We'll be back Monday. Thanks for listening.